How's it going, everybody? Welcome back yet again. June 18th, 2021. Beautiful day here in Chicago yet again. And this is Positive Theta Trade Management, the YouTube series where we go over trades that result in a net positive theta in our brokerage accounts. If you're new to the channel, please be sure to leave a like, comment, subscribe, and let's get right into this next video in the series. In this video, we will be going over strangles, which are essentially undefined risk iron condors, selling a call and selling a put out of the money without buying any protection. So let's see what the strangle has to offer us. So what is a strangle spread in options trading? A strangle spread is constructed by selling a call and a put out of the money without protective legs defining your risk. Extremely similar to iron condors, these are usually done at strikes that are 70 to 80% out of the money. Less than 70% out of the money is a very aggressive strategy. IV rank of being over 40 is ideal. Brings up profitability dramatically if the underlying has an IV rank of higher than 50. Moving over to a screenshot of an options chain of a strangle that I have open right now. This is on corn futures. So as we see here, I am selling the 515 put, which is 76% out of the money. And then I am also selling the 650 call, which is also 76% out of the money. So how do we trade strangles? After we've identified an underlying with an IV rank of over 40, we look to sell the 70 to 80% out of the money strike, call, and put on the same ordered ticket. The strategy differs from defined risk spreads in respect to the premium collected. For example, on Tastyworks, due to their relaxed margin requirements, we can receive tons of premium, 40, 50%, or even more, in relation to the buying power reduction it takes to open the trade. We typically sell the spreads as close to 45 days until expiration as we can, and managing at 21 days until expiration. At 21 days until expiration, we will either roll our spreads out to the closest 45 day till expiration option to gain more time and credit, or roll up or down to make the spread in line with what we are looking for. Our profit target is 40 to 50% of the premium we received. If the profit is hit before 21 days until expiration and volatility contracts enough, we will close the trade and realize the profits. If there is still high IV rank, we can roll our options to a further expiration and extend our break-evens even more. Trade metrics. Positive theta. We are positive theta when selling strangles, which means money is coming into our brokerage accounts every day as long as the position is open. Short vega. We are selling options in high implied volatility / IV rank environments, and we're expecting a contraction in implied volatility, as implied volatility has mean reverting properties and is consistently overstated when compared with realized volatility. Delta neutral. We look to set up strangles as delta neutral as we can. By establishing a strangle, we have a range that the underlying trades within, similar to an iron condor. We aren't looking to profit via directional movements of the underlying. We are looking for profits with a contraction in implied volatility as well as time decay. So let's move into some live examples as we always do. So here we are on Tastyworks. We're going to be going over the corn future strangle that I showed in the slides example before. So as I showed before, we're selling the 515 put, selling the 650 call. Slight bearish deltas, but basically we're establishing the range that corn will be trading between 515 and 650, and we will be profitable. We are getting 41, almost 42 thetas for this trade, which means every day we have this trade open, we are receiving, in theoretical value, $42 a day. We received 27 credit for opening this strangle. This is in futures quotations. Each point for corn futures is $50, so we received $1,350 in premium for opening the strangle. Let's take a look at curve analysis and see how our risk profile looks. So we're over here in the curve analysis. This is how our risk profile looks today. Our break-evens are right at about one standard deviation. One standard deviation is marked by this pink line right here, So for our break-even at expiration is sitting at 488 for the put side, and we are sitting at about 677 for the call side. So as long as this strangle is trading within 677 to the upside and 488 to the downside, we will be realizing profits if we hold until expiration, which is something that we never do. We always look to close before expiration or roll out to a later dated expiration. Let's take a look at the evaluate date feature of Tastyworks and see what this spread will look like at 21 days until expiration. So at 21 days until expiration, with all things remaining equal, we didn't do anything to volatility, just fast forwarding and seeing what theta decay will bring us into our account. We are sitting at about a $555 gain, which is just over 40% profits. If everything else remained the same, volatility didn't contract, which we're looking for a contraction in volatility, so this might be a bit more at 21 days until expiration. But to keep it simple, just off of theta, we would be realizing profits at about 40% if corn traded within about 560 to 600. It would be just under 40% if it was at 560, just under 40% if it was at 600. Within 560, 600, we'd be seeing about 40% gains, at which we would close the trade and realize the profits. Bit of a shorter video today. Thank you all for tuning in. Hope to see you in the next one. Happy trading and have a good day.